Hi guys, good morning. Welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Not a great morning where markets are concerned, given the fact that we are looking at kickstarting the week on the back foot. If GIFT Nifty is anything to go by, we can expect another gap down start for our markets. Of course, we have broken below that December low of 23,460. So the next level to keep on your radar should be the November low of 23,263. That would be the crucial level to watch out for. Bank Nifty as well, has broken below key support levels. So, what should one really be doing in this market? We'll touch base with our experts and ask them this question. And of course, lots of stocks in focus today. You have HCLTech that will be reporting numbers. Remember, IT stocks saw very good traction on the back of good commentary coming in from TCS after inline set of numbers. So, IT stocks will be in focus as well. And a lot of big ticket IT numbers will be reporting numbers throughout the week. So, yes, IT stocks in focus. Just Dial, DMart are some of the numbers that came out over the weekend. So, we will be taking stock of that as well. So, lots of stocks in focus. All your stock related queries will also be in focus. So, keep them coming in and we'll try and take them up. But of course, before we move any further, let's quickly take a look at the top headlines at this hour. Stock sell-off on Wall Street on Friday as stronger than expected jobs report raises concerns of a more cautious Federal Reserve. Asian markets also opened largely lower. The Nikkei Kospi were all down in excess of 1%. The GIFT Nifty is also hinting at a gap down start for our markets. Crude prices rise and build on to Friday's gains as the US announces sweeping sanctions against the Russian oil industries, taking Brent to over $81 a barrel. Gold prices in fact rise on uncertainty around Trump's policies. India's industrial production growth improves significantly in November, grows at over 5% versus estimates of 4%. CPI for December is expected to come in lower on a year-on-year basis and sequentially at 5.3% as food prices cool off. DMart posts weak third quarter earnings. Revenue grows over 17%, but margin contracts and profit disappoints on increased discounting and operating expenses. Neville Noronha will also step down as the CEO, ending his 20-year stint at the company. Anshul Asawa, who is currently Unilever's country head for Thailand, is appointed CEO designate. In key earnings today, HCLTech is expected to deliver 4% revenue growth and higher margin in the third quarter. The street will also be watching out for any revision in its guidance. Well then, let's quickly take a look at the cues for trade and how we really ended on Friday. Well, it was a third straight session of losses on the index. The Nifty in fact broke below the 23,450 mark amid broad-based sell-off. However, TCS saw its biggest single-day gain in nearly 6 months. IT stocks, of course, was the only pocket IT index that was in the green. I think it ended higher by about 2.5% or thereabouts post TCS numbers. The market, of course, saw its biggest weekly fall in nearly a month. Sensex Nifty were down 2% apiece last week. The mid-cap index, however, fell the most in over 2 months. The headline was not the headline index. The headline was the broader end of the markets, because we saw a fair bit of pain in the broader end of the markets. Both the Nifty mid and small cap indices shed anywhere between 6 to 7% apiece, and most of the stocks on the mid cap index were down anywhere between 10 to 15 to 20%. So a lot of panic when it comes to the broader end of the markets. All the other sectors were trading in the red. In fact, PSU Bank index was the top sectoral laggard last week, fell 8%. So entire PSU basket, including PSU banks and other PSU names, came under a fair bit of selling pressure. The Nifty put call ratio declined to 0.88 vis-a-vis 0.92. Some of the stocks that will be in F&O ban would be the likes of Bandhan Bank, Hindustan Copper, Manappuram Finance, RBL Bank and L&T Finance. And in terms of flows, FIIs have been consistent sellers since the start of the year and they continue to sell. So 2200 50 crore worth of selling in the cash markets where FIIs are concerned, and domestic investors, however, continue to pump in 3,900 crore rupee worth of buying in the cash market. On that note, let me bring on board Sudeep Shah, who's the head of technical and derivative research at SBI Securities, who's joining in this morning. Sudeep, lovely to have you on the show. We are meeting for the first time this year. Wish you a very, very happy new year.
Happy New Year, Nandini, to you and the entire team at Money Control Opening Bell and all our viewers now. But it's not a good morning, let me tell you. Looking at the way we are seeing at the global markets and the GIFT Nifty opening, it's not at all a good feeling, and we are opening below an important support zone. So I feel we need to be a bit cautious here.
Definitely not, turning out to be a good morning. In fact, since the start of the year, although we started on a positive note, since last Monday, of course, the texture has been extremely poor when it comes to the market, even in the broader end of the market. But let's talk about the headline indices first. Nifty has, as I mentioned, broken below the crucial support level of 23,460. That was a December low. And now next level, is a November low of 23,263. But in between that, would you look at any kind of support level, or do you think 23,263 is the level that one should work with now?
Uh, See, Nandini, I feel like the important level from here on would be closer to 22,900, 23,000. I know it's a bit far away from the current levels, but looking at the way GIFT Nifty is showing, and the implied open, which is even below 23,200, and that is below the those old swing lows of 23,263. So now, uh, firstly, in the first half an hour, 1 hour, it's important to see whether we are once again crossing beyond 23,300, 23,350 post the opening. Is the cut being reduced? And if that does not happen, then the next levels to watch out for on the downside would be 23,050 and 22,850, 22,900 thereabouts. But the texture is definitely not good. And even if we see some kind of a recovery post opening or throughout the first half, and one should not be bottom fishing. Just wait and watch for a few days. Do not take any aggressive bets, as a lot of global cues are also not in our favor. So need to just give the markets a couple of days for it to settle, and then take a call from there on.
All right, it's not advisable to be very aggressive in this market. And at the pre-open, when I'm looking at the headline indices, the Nifty is at 23,195, even below that 23,200 mark. So, it looks like we are poised to retest that November low as well in today's session. And let's see how the broader markets really pan out, because in the pre-open, it's not looking very good at the current juncture. But talking about the Nifty Bank Index as well, how would you be positioned here? Because we have broken below all the crucial support levels here. What would you be working with, when it comes to strategies when you look at the bank stocks?
See, if you look at the bank nifty now here, there was some kind of a consolidation in entire between the October to December phase, but the breakdown has come in the last week below 49,800, 49,700 zone, and now the kind of opening that we are expecting today, which is closer to 48,000, 100. I feel now on the downside, important support would be closer to 47 300, 47 500 levels. And although it's in an oversold territory, it's approaching that zone, so there could be intermediate pullbacks. But until and unless we see the levels of 48 800, 49,000 once again being surpassed, and bank nifty closing above this level for a couple of days, there would be no signs of any credible reversal. So I feel 49,000 is the zone that one should be eyeing from a reversal perspective. And on the downside, the next important major supports first would be 47,800, followed by 47,200 on the downside.
Okay, that's about the levels to watch out for on the Nifty Bank Index. 49,000 on any bounce would be a crucial level to watch out for. I want to get in your thoughts on an IndusInd Bank. This stock has been among the major underperformers, within the banking pack, down 40% or so in the last 1 year. And in the morning, they have released their December shareholding pattern. Just want to take you through it. The foreign room has jumped to 37% after the changes in December shareholding. It had missed the MSCI full weight threshold of 25% by 5 basis points in the September quarter. Now, MSCI will increase its weight from the current 22 basis points to 44 basis points. And the increase in weightage will attract inflows to the tune of $225 million. Given the fact that this has been quite a big underperformer, do you see any kind of reversal in the trend? Would you say that the stock has already seen the worst and may have bottomed out? Because this bit of news comes as some bit of a positive for the stock.
Although this news sounds positive, but if you see the kind of trend that the stock has displayed over the last 3 months, right from the time, I guess, first week of October, from where the stock started its slide from around 1450, 1500 levels, even the Bank Nifty was outperforming during that phase. The stock started underperforming quite before Bank Nifty. So here I feel, even though this news is kind of positive and may have some couple of percentage points sentimental impact on the positive side, but until and unless this zone of 1040, 1050, which is now a bit far away from the current levels, 8-10% from the current levels, until that zone is not crossed, the larger texture would be on the downside. The trend is tilted on the downside, and maybe a rise because of the oversold nature of the chart. There could be a rise, and this positive news supplements that. But on the upside, if this 1020, 1030 mark is not crossed, then I'm looking at around 800, sub 800 levels on this stock, and this could still continue to underperform, even though after a week's time you see a bounce back in Bank Nifty. So I guess I would not be touching this stock even from a bottom fishing or from a medium to long term perspective.
Okay, the trend remains on the downside when it comes to an IndusInd Bank. That's the view. But IT stocks, we cannot not talk about IT stocks because that was one pocket that gave some solace in Friday's session. HCLTech will be reporting numbers today. Seasonal strength in products business is expected to aid performance. This is one stock that defies the seasonality and does well because of the strength in products business in the third quarter. Typically a good quarter for its products business. Revenue is likely to be up 4% or so on a quarter-on-quarter basis. Net profit expected to grow 8.5%. Products platform business revenue likely to be extremely strong, and deal wins are likely to be in the range of $2 to $2.5 billion. Margins are also expected to rise, but it's the guidance, whether or not there's some kind of upward revision in the guidance. So that will be crucial to watch out for. But there could be an impact of wage hike on the margins. But within the large cap IT universe, which stock would you bet on? I will come to you on that, Sudeep, in just a bit, because we are just about looking at the market open. First ticks coming in, and yes, almost a percent kind of a cut on the index, almost a percent down on Nifty. 220 points down. So it's a gap down start. We have broken below that 23,236 mark, which I was highlighting at the start of the show, broken below November lows as well. Sensex has slid somewhere around 700 points. The mid cap index 1.5% down. So yes, the pain continues, and it's the broader end of the markets that is witnessing quite a lot of drubbing. As I mentioned, some of the stocks are down 15-20%, in a week. So yes, that's the kind of panic selling that we have seen. But interestingly, IndusInd Bank is among the couple of gainers on the index on the back of the news flow that I just pointed out before the market opened, almost 2% higher on IndusInd Bank. But aside of IndusInd Bank, all the stocks on the Nifty are trading in the red. Bank Nifty down another 500 points, so it's 48,200. That's the kind of level that we are looking at when it comes to the Nifty Bank Index. I want to quickly see what some other sectors are doing. IT was true to its name, behaving like a defensive, was up in excess of 2% on Friday. Today, I think IT pack has also succumbed to a weakness, 0.5% down on the IT index. Autos are down in excess of 1%. You have consumer durables, that index is down 1.5%. Energy pack is down 1.5%. Look at the metal pack, down 1.5%. So yes, it's across the board sell-off. The India VIX has jumped 7%, almost at the level of 16. I want to see the advanced decline ratio dismal, so to say, 1:5. That's the NSE advanced decline ratio. 300 stocks advancing to 1600 stocks declining. That's the kind of pain we are witnessing. So yes, a very weak start to an earnings heavy week where we have numbers from Reliance Industries, the likes of Infosys, and a whole host of other mid cap IT names as well. In terms of losers, BPCL, top Nifty laggard, BEL, Power Grid, so all these PSU names continue to witness selling pressure. Remember, crude is back above $80 a barrel, which is why OMCs will feel the heat, and so will the other crude related companies. M&M, NTPC, Trent, all the other laggards. But on the gaining side, we only have IndusInd Bank that's gaining somewhere around 1.5% or so. Looking at the open, so the 23,190 is where we are at. For the day, would you expect any kind of a reversal today, or do you think it will only go downhill from here?
Nandita, too soon to call it, say, a reversal point. But yes, this zone of 23,150, 23,200 would be an important level to watch out for, because post this gap down, a lot of negative sentiments would have been taken care of. And what we feel is that there could be some kind of a recovery. Yes, definitely a pullback, maybe a 70, 80 point pullback, and then that would be the right test for the Nifty or the volatility. As we are seeing, the VIX is up closer to 16 levels. So we feel that there could be a pullback, but the real test would be closer to 23,270, 23,300 zone, whether the index is able to surpass that, or once again you are seeing a second bout of selling pressure from the higher levels. Because generally in these kind of gap down openings, you see a recovery, and post that there is one more round of selling pressure, and that is more brutal. So the next 45 minutes would determine the entire texture for the course of the day, as well as for the next couple of days.
All right, as you rightly pointed out, any kind of buying that comes in is followed by, an intense bout of selling pressure as well. So yes, things aren't looking all that great. But I was talking to you about the IT pack within the large cap universe. Would you look at any of these stocks now, because they have seen a fair bit of good up move in the last 1 year, even the last 6 months have been pretty good. Would you take a bet? Would you say that there is more, steam left in some of these stocks like TCS, Infosys? If yes, which one would you choose in terms of chart movement?
In terms of chart movements, Sanjita, if I have to choose, say, one or two stocks, it could be Infosys and HCLTech way ahead of TCS. Although TCS offers some kind of a stability, but Infosys and HCLTech, even within the large caps, they do give higher returns compared to TCS in terms of, say, volatility, and if you are able to catch the swing lows. So what we feel is that Infosys as well as HCLTech could outperform TCS in terms of the price performance, in terms of the momentum in the next couple of say weeks. And the IT index itself is at a quite sweeter spot. So I feel in case of any further downside into the Nifty, it could be the IT index which could still continue supporting Nifty and at least cut those losses from a major perspective.
All right, that's a view on IT. But before I move on to queries, I want to quickly get in some result reactions from you. DMart, for one, stock is down 3.5%. Of course, stock has been stuck in a downtrend for many months now. Just quickly taking you through the numbers, profit and revenues have been okay, but it's the margins that have disappointed. Even profit, for that matter, has been some kind of a disappointment. Margins have contracted to 7.6% vis-a-vis 8.3% on YOY basis. But the most important announcement, during the numbers was the appointment of Anshul Asawa as the CEO designate. With effect from March 15th. Now, Neville Norhunha will complete his term of 5 years on 31st Jan 2026, but he's decided not to continue, and Anshul Asawa will be succeeding him with effect from 1st Feb of 2026. Looking at the brokerage views, it's fairly mixed. But the expectations were also pretty low, right? Some of them have pointed that out, and in comparison to that, Bernstein believes that numbers have been a positive. EBITDA and PAT margins may have declined largely due to higher grocery share. But, looking at the charts, it is actually moving towards its 52-week lows. Would you expect the stock to test those levels before we can see any kind of recovery? Because 52-week low is just a shade under 3,400 rupees. Would you expect those levels to be violated as well, especially after the numbers?
Yeah, definitely. See, if you see the trend of the stock, right from September, the stock is in a complete downtrend, and the downtrend has accelerated day by day and week on week. Right from 5,400, the stock tested 5,400 where it was in end of September. The last week of December saw the stock testing 3,400. And post that, there was some pullback, but that was just because the oversold nature of the stock. And once again, this signifies the second down move from say 4100 right now to 3600. This signifies that it was just an oversold. It was, the bounce was just because of the oversold nature of the stock. And here now, till the time 3800, 3850 is not crossed, I feel the downtrend will be intact. Maybe some consolidation could be there because the results have come out. All the negatives are now out, and uh, we might see the stock consolidating. But yes, for the stock to move up and for it to come back to 43, 4400, 3800, 3830 resistance has to cross. And on the downside, if 30, if 3530 is breached, I guess the next support could be closer to 3300, 3350 levels, way below that old 52-week low.
Okay, that's a view on a DMart, but the other stock that's reacting pretty strongly to its quarterly show is PCBL. That stock is down 9%, and this stock has come off quite a bit, right? Starting end of September or beginning of October. But after weak numbers, where do you expect the stock to take support? In fact, I think I also spotted a query on our feed on this particular stock. It was from Satya CK, if I am not mistaken. How would you trade into this stock now, PCBL? Uh, both short to long term. How would you look at it now?
Nandita, from both perspective, short as well as the long-term charts, they are disturbed. The charts, if you this current fall now, just today's fall below 380 has has had a significant cut to this, because if you see in November there were a couple of swing lows closer to 380, 383, and every time it was retesting that zone, there was a bounce back. But this time, because of the results, because this swing low has been breached. And I feel even though because it is down 8, 8, 9%, there could be some kind of a pullback from lower levels. But now till this 380, 390 zone broadly is not crossed, there could be a retest of 330, 335 levels in the next couple of weeks. So I would not be too keen on bottom fishing in this counter. Even if someone is holding from higher levels and wishes to do any bottom fishing here, I would still request to wait for a couple of days and then take a call closer to 330, 335 levels on the downside.
330 to 335 levels on the downside. That's the view on PCBL. But another result candidate is Just Dial. This stock is also being punished by the street, 7% lower as we speak. The net profit has jumped in excess of 43%, revenue up 8%. Margins have also seen a good expansion, 30% vis-a-vis 22.7%. But this stock has also been in a downtrend. If you look at the last 3-month performance, it has shaved off in excess of 25%. Any thoughts on this stock as to where it's headed? 955 is where it's at the current juncture.
Nandita, here also, if you see last 4 or 5 weeks, low has been breached today with this opening just in the first 10 minutes. And the stock is trading now way below its June lows also. So what I feel is it is now coming back in that range before the breakout had happened in say April 2024 above 950. The stock could now start trading in this range between 800 and 1000 levels. It could re-enter that consolidation range with some kind of volatility and negative bias. So my sense would that we just avoid bottom fishing here, and the stock could retest levels of 900 and 885 levels on the downside.
Okay, that's the view on Just Dial, but let's shift focus to some queries that are coming in on our live feed. We've already taken one query, but the next one is on Canara Bank. Naveen has written in and he is making a loss of 20% on his holdings. He wants to know whether he should hold or exit. I can't see any ray of hope when it comes to the charts of Canara Bank as well, because last 6 months the stock has shaved off over 20%. Even the start of the year hasn't been good, a 9% cut so far this year. month to date, January. Would you advise him to stick on average or just cut his or just book his losses? How would you ask him to navigate his
Uh,
position?
Now, it's a tougher call right now at this point, even to advise someone to exit the position completely, because the stocks are now approaching their oversold zone, and it's just say a few days or a couple of days away before you could see some kind of floor being formed, at least from a market perspective. So I feel yes, the stock has already corrected from 112 to 90 odd levels, and this could still if this could still continue up to 85, 87 levels. So if this holding is from a long term perspective, medium to long term perspective, yes, the trader can still continue to hold this position, and closer to 85 levels you could average this, because around 85 levels the stock would reach an important Fibonacci retracement support zone also. So I'm expecting a bounce back from 85, 87 levels. But at the current levels, just wait for a while, try to add closer to 85, 87 levels. And the first sign of any reversal in the stock would be when the stock closes above 95, 95 and a half levels. So 95 on the upside will be an important zone to watch out for from a reversal perspective. At least that will give you a sign that the bottom is getting formed here, and at least some kind of a floor is being set for the stock. And on the downside, 85 levels would act as a strong support.
All right, that's the advice on Canara Bank. Hope that answers your query and helps you with your holding, Naveen. Next query coming in from Vinod Patange wants to know your thoughts on Page Industries. I think he's making a 30% profit on his holding. He wants to know if he should book his profits or wait for more upside, if any. In the last 4 months, Page Industries has seen a good 15% up move. If I look at the charts from the 10th of September, it's seen a good up move. Would you see more? What are the chart patterns suggesting now? And should he wait for more profits, or should he actually book partial profits?
I feel Nandita, you should book partial profits. Although the stock has outperformed now, there's no denying this fact that the stock has not outperformed against the markets. Where the markets were in the downtrend, the stock has either held on, or it has seen some kind of buying support from the lower levels also. So yes, this is a clear case of outperformance. But from a typical trading perspective, or from a risk reward perspective, one should at least take off partial profits, and once again, if there is any significant dip in the stock, can redeploy that part of capital which he has booked earlier. And on the levels perspective, now 45 800, 45 900 will act as a strong support on the downside until this holds. This rally could continue up to 47 200, followed by 47 500.
Okay, that's the view on Page Industries. You can look at booking partial profits. Hope that answers your query. I want to take up this query from Geetu Sandesh on Godrej Consumer Products. Now, some of these FMCG stocks have seen some bit of buying interest since last week. In fact, if you look at the month to date return on Godrej Consumer, it has jumped 9% or so. So, and even today, it's barely trading flat, with a negative bias, no big cuts coming in on this particular chart. Has there been some kind of a reversal in trend for some of these FMCG names? And, if you are spotting any kind of reversal, what kind of an up move should one expect in a stock like Godrej Consumer?
See, if you see in the last couple of days, there has been some pullback in the FMCG names. You've seen Colgate, you've seen Nestle. They also have some kind of a reversal from the lower levels. Now, Godrej Consumer Products specifically, if you see, uh, 1150 now becomes an important support. So till the time 1150 is held, you could see a pullback up to 1210, 1220 on the upside. But 1150 now has to hold. And apart from Godrej Consumer Products, I feel Olpal is one stock which should be on our radar. There is some kind of a bottom formation here. And about 2880, 2875, 2880, the stock could head up to 3050, 3100 levels. So this is the conditional buy about 2870, 2880 levels. that the stock could head up to 3050 levels.
Okay. Okay, we're talking about Goodrich Consumer, and of course, all the FMCG names have also witnessing some bit of pressure, buying interest. Last query then, can't really get the gentleman's name or the lady's name, I don't know, but the query is on Syrma SGS. Now, some of these stocks like Syrma and even Dixon Tech, these kind of stocks, EMS stocks, so to say, have come under a fresh bout of selling pressure. We've seen, Dixon Tech also shed quite a lot. But these stocks have been multi-bagger stocks, so to say, the last couple of years. In the current scheme of things, how are you viewing some of these stocks on the charts? Do you see this dip or this weakness as a buying opportunity for the likes of Syrma and Dixon Tech as well?
Yes, if you see from a stock standpoint, now Dixon, the kind of business is into and the kind of results that the stock is being able to generate in the last several quarters, uh, I guess that the valuations, expensiveness of the valuations will always remain. But it's just that the last few months, the stock had a superb run. Now, if you see the last 4 or 5 months, the stock has almost doubled from 9,000 to 18, 19,000 on the upside in case of Dixon. So there could be some kind of a consolidation, some kind of a retracement that happens here. The business, there's no denying the fact that there's any problem with the business. No, then they are getting adequate orders, they are getting adequate business, and the margins are also intact. So here it's just a case of the stock being overpriced a bit earlier than required, and we are seeing that excess now being shaved off. So in case of Dixon, 15,800, 16,000 now will remain an important support on the downside, and here 17,000, 17,100 needs to cross for a fresh bout of buying to emerge here. So the stock could consolidate here in this range. Now coming to Syrma, there the stock is not seeing any deeper cut like the cut has been there in case of Dixon, because the stock has not moved that much in that with that velocity like Dixon has moved. So here Syrma, if we see 545, 550 would act as an important support on the downside. Although last couple of weeks the stock has had a negative consolidation, or some kind of bias was negative, but the cuts were not deeper. The cuts are just 5-7% from the higher levels in the last 3-4 weeks. So I feel that in essence, this is kind of an outperformance compared to other mid caps, and this space will still remain in focus once the markets are settling down in a range. So 540, 545 zone in Syrma would act as an important support. And I feel this could still witness buying support once there's some kind of a revival into the markets, or at least markets enter into a consolidation range.
Sure. Sure. With that, we've come to the end of the query segment. But Sudeep, any recommendations for viewers? What should one do in this market? Anything to buy, or should one stay short? What are your ideas?
Not to stay short, because now I guess we are at a very crucial juncture. As we were discussing in the beginning of the show, also that 23,263, which was the prior swing low, is very crucial, and indices are trying to navigate that, and they're very close to that zone. So today's trading would be very important, and I guess it'll be too early to call fresh shots from the current levels, and let the markets consolidate between this 23,000 and 23,500 zone before they take any decisive course. But yes, stock specific, while we were talking about FMCG and consumption names, one stock which is still coming on our radar is Marico. And we feel that this stock has given a breakout of a consolidation range between 615 and 660 that it was trading for the entire month of December. And here on the downside, 655, 653 will act as an important support. And the stock could head up to 698 and 705 levels. So this could outperform here for the next few days. And being defensive, I guess that should ideally be a preferred pick from a trading as well as from an investment perspective.
Okay, those were the recommendations coming in from Sudeep. With that, Sudeep, would like to thank you for taking out time and joining in and sharing your thoughts with us. Look forward to more interactions going forward.
Thank you, Nandita. Same here.
Right. Well, on that note, let's quickly take a look at the market. 200-point down on the Nifty, 23,230 is where we are at. We have taken out the November lows as well, but we've kind of clawed back slightly from the opening lows. But on that note, a big market voice, as I had promised at the start of the show, joining me is Sunil Subramaniam, market expert. Sunil, Happy New Year. But looking at the screens, none of us are feeling happy. Of course, 10% off highs, entered into the correction zone once again, and we are right. We were in where we were in the month of November. How's the mood?
Well, obviously the mood is nervous because I think it's a big event filled the next couple of weeks. The Trump inauguration, the economic survey, the budget, and then the earnings season would probably, a third of the earnings season will be done by the end of January. So I think with so much of uncertainty around, the risk premium has shot up in the market. And especially FIIs, right, are in a situation where Trump is causing nervousness every day with this kind of announcement. Now, there's a lot of noise created by the Trump administration, not the administration yet now. But when come Jan 20th, when he takes power, how serious are some of these actually going to get implemented? So there's a market is very, very nervous about that. They are unsure. And right now, US debt seems the safest bet for an US-based FII because he's getting 4.5% risk-free, currency risk-free, default risk-free. So he's probably sitting on this cash, waiting for these events to play out. There's no India-specific trigger. We are coming off a period where our GDP is disappointed, earnings season disappointed. There are expectations this earnings season could be better, GDP could be better, but the previous earnings season and the GDP numbers were not anticipated by the market. Market being taken by surprise is now hesitant to make a strong call on that the earnings season will be better, or the GDP. RBI governor did say that from 5.4 this quarter would go up to 6.8. But like I said, once bitten, twice shy. Previous time, the RBI governor had stuck to 7.2 as a year's target, and then he revised it down to 6.6 in his last policy. So a lot of this means that, and then the government also, the statistical part has come and now revised the figure for a lot of the gold imports and all of that. So there's a question around the veracity of the data. So I think there's too much uncertainty right now, and I think investors. And the important point is the FII action, while it's justified because of all of these, and also the fact that Trump has now suddenly put sanctions on the Russian vessels, and he's forcing Europe to buy US oil. So oil prices are shooting up. So India specific, you can understand that FIIs are nervous, but domestic fund managers, in reaction to this, are also sitting on cash. They're also not buying. In fact, they're booking profits in the small cap and mid cap and keep waiting for the earnings season and the budget to give them direction. So right now, it's just nervousness prevailing all over.
Well, rightly pointed out, nervousness all across the board, and we've seen that nervousness particularly play out in the broader end of the markets, right? Clear pain. I mean, I don't want to use the word panic, but if you look at the movement since last Monday or last Friday, so to say, we've seen, including today's move, we've seen an 8% cut almost on the Nifty mid-cap index. Some of the stocks have shaved off as much as 15 to 20%. So that's the kind of nervousness that's there. So when one does start deploying funds, do you think large caps would be a safer bet? Do you expect the leadership to come from there? Because even now, even the large caps are not taking the leadership.
No, that's because I think, like I said, large caps are an FI dominated space, right? And even the large cap fall would have been much worse if not for the IT helping soften the blow. So, yes, I do expect that the recovery will start from the large caps for the simple reason that I think that it's the FII flows returning to India in whatever form post the earnings season and the budget that are going to drive the market. And I see domestic fund managers, the fall has been caused by domestic selling because FIIs don't play a big part in the mid and small cap segment. So clearly, domestic fund managers are worried about the valuations. They are booking profits. And when they redeploy, whether they put it back in mid cap, small cap, or large cap would depend on these numbers. Whereas FIIs are clearly going to come in, and whatever buying they do, even if it's little, is going to be in the large cap. So many stocks are off their 52-week, on their 52-week lows. So in the large cap space, there's comfort. And I would say that the first step of buying from FIS, obviously it's going to be in large cap, but even domestic fund managers, I would expect that they would step in and buy large caps where the earnings guidance. So the earnings season also, there's a quarterly earnings which is for the past quarter, but there's a guidance for the year, which is very crucial. So I think those where the guidances are coming good. See, TCS results we talk about, right? It's not just the good earnings, it's the guidance that came through for the overall IT sector got impacted. So I think definitely large caps are where the initial rally will happen.
Since you mentioned TCS commentary, if you look at the positives and negatives for the IT sector, there is a sort of a tug of war still, right? Commentary has been good, rupee tailwind is there, deal wins have also been surprisingly good if you look at TCS. But Trump policies do pose uncertainties, right? Because even in terms of rate cuts, some of the brokerage notes I was reading said that there may not be any rate cuts, Fed rate cuts this year at all. So how would you balance it out, the positives and negatives, and in that light, how would you approach the IT sector?
So I would say that I think the rupee depreciation part is overdone, because I think the dollar strength is overdone. I'll tell you why. The dollar is strengthening because of money flow into US treasuries. The dollar is strengthening because the rate cut scenario has now kind of paused. Earlier there was 4, then there's 2. Now you're saying no. There are some parties saying no. But it's also that the Trump actions are indicating a stronger US corporate sector and hence corporate earnings, and so there's a positive entry to that. But bear in mind that for Trump to succeed, he needs a weaker dollar, not a stronger dollar. If he wants Europe to buy American oil, the landed price of American oil in Europe has to be less. So the dollar has to be weak. So while generally one associates saying Trump MAGA with saying America is stronger, it doesn't mean that he wants dollar stronger, because that's going to hurt American exports. So I think that the dollar rise, I think, is overdone. That's my personal opinion. And I think that it will ease. So from that IT sector, the tailwind from depreciation, I think the extent that the market is expecting that, I don't think it's going to happen. That's number one. And even if it does happen, the buyers for IT are the big corporations in the US. They will negotiate down the price to make adjustments for the depreciation, right? That's the bargaining power. So I think that's a bit overdone. So it's there, its effect is there, but not as much. But it's the deal book which is, I think, positive, which means that if America is going to get a revival due to corporate tax cuts, due to supportive Trump policies, then their IT buying will step up. Not only because over the last few years they haven't done much, post-COVID they did a bit, not much, but the AI, every industry today is facing the pressure from AI and they need to adapt to AI. So that needs a lot of consulting, needs a lot of repushing. So I think IT companies on a strong wicket, those which have got the AI capabilities on consulting side, are probably going to win a lot of orders in the coming years. And so to me, in the balance, IT still continues to be a good pick, like I said, for that reason. And I would focus myself on those companies where the AI level of advice and consulting strength is there. Those would be the ones who win, not your traditional IT software, outsourcing kind of a work. And the other thing is that I think market has also recognized that this whole immigration piece is not going to affect so much the H1B issue, because I think Trump is after illegal immigration and then the low-end immigration. These are high-end workers where America needs it, and America corporate is making up with Trump big time. Though they opposed him in the run-up to the election, today they are making up. So I think you could see that Trump will definitely be favoring corporate America, and so those things, they will want the H1B, because not only from a perspective of them improving their performance through partnerships with the IT companies, the fact is that, the GCC kind of a work also, right? That will also get a boost, because it's American companies which are coming and setting up the shop in India, will mean that the exports will be from India, but by an American corporation itself. So to that extent, I think the GCC thing will continue to grow.
Right. I want to also get your thoughts on, what happens to the China plus one benefit that we were looking at, because Trump, so far he has emphasized on making America great, make in America, so to say. If that happens, do you think, China plus one as a theme would take a back seat, or do you still see, some bit of value in or some kind of recovery in China plus one as a theme, like chemical stocks for one? Would you look
No,
at
I
that now?
definitely see value there because of the fact that we all, market is expecting or initially is expecting that China would get hurt by the tariffs. But please understand that China is not sitting quiet. China has bargaining tools on its side. First, the US can't cut off imports from China. Okay, number one. Number two, China holds a huge amount of US dollar securities, treasuries. So they have a currency to fight, right? The dollar strengthening means the yuan weakening has actually helped the Chinese cause. To that extent of the dollar strengthening, to yuan weakening, the tariffs will have less impact, right? That's the second point. The third point is China is rapidly building up its capabilities outside of China. So what they're doing is they're tied up. Obviously, Vietnam is a big, big partner for them. But I see India also making a play. So I see China plus one becoming China plus one in specific sectors. Pharma, API, chemicals, a lot of these places. What will happen is a bulk of the manufacturing will be done in China and they will try to finish it in India. And I see that India is moving politically towards that. That's why, we had the, border situation easing up. We are talking now. So I think that the pragmatic approach for India also is to partner with China and the product is finished in India and sent out. If they 70% or 60% of the work is done in China and the finishing part of 40% comes to India and then the product is made in India, you the differential tariff, right? Now, why Trump is well aware of this? Why will he allow that? Because remember one thing, tariff is a threat. But if implemented, it means US inflation for the retail US consumer is going to rise sharply. A new president doesn't want that happening. So the balance between strong talk and strong action, right? They say, the dog that barks a lot doesn't bite the most. So I think the Trump administration in coming to power will take a pragmatic approach. All these noise levels will come down. There will be, and Trump is a very good businessman. He will negotiate hard. He will get on the negotiable table with China, with India, with everybody. Nothing is going to be free. So, but overall, America as a country is heavily dependent on importing from the whole emerging market space. And they can't afford to make in America and sell in America. So what Trump will try to do is make in America and export where those products are needed, like defense, for example, to India, like oil, for example, to Europe. So those two ways the trade arrangement. At the same time, core products where labor cost is important have to be imported. The US is at $80,000 per capita income. China is at $13,000. India is close to 3,000, 2,800, 3,000. This huge difference in per capita income translates to a similar difference in per capita wages, though productivity factors have to be taken into account. So there's no choice for Trump America not to buy. So the point is, it threatens a 60% tariff. Part of it gets taken away by depreciation of the yuan. Part of it, he will negotiate with them, saying approve the price reduction. So overall, there is going to be a balance. So to that extent, this story that China is going to go down because of that is also not fully true. China is also getting into robotics and AI in a big way to supplement their high labor costs vis-a-vis India. So they're also adapting to the new situation. So I think that India has to play smart. The China, already we are seeing electronic manufacturing services has been a success. But to spread that across a larger sphere, right? India must get on a silent partnership with China at a lot of spaces, and then we can take advantage of it. So I do think that the China plus one has to become China plus one. And I think this budget, one of the things I'm looking forward to is how are they going to use the PLI scheme in a smarter way to facilitate all of this. So I definitely see the China plus one as a continuing support story for India's growth story. No doubts about that.
All right, I think that's a very good explanation, Sunil. I mean, I want to extend this discussion even further because you've really put it into perspective for us. One final question then. I was just reading a report last week where I think CLSA had taken a contra call on the entire consumer staples space, which has seen quite a bit of pain. But that contra call was on the basis of the fact that there could be more consumer tilt in the budget. If I asked you to choose between capex and consumption, what theory would you apply here? Would you say that the government would do much more to boost consumption in the wake of growth slowdown, or would you say that the spending on capex, defense, railways will continue and that will take priority?
No, I'm in the CLSA side here. I think that the government's budget will be much more populist than previous budgets. The reasons for that are very clear. The first is that the Lok Sabha elections gave a big shock to the government. The Haryana and Maharashtra elections saw populism being stepped up in a big way and helped them win back those states. And with UP and Bihar in the pipeline over the next couple of years, I think that the government has learned the lesson that development capex, which doesn't get felt on the ground by the common man, is not worth it. So part of the reason for the government dialing down on capex this year vis-a-vis their budget is, I suspect, this. They will come out. I don't expect them to spend that 11 lakh crores they promised in the budget last year. The real estimate, revised estimate, which comes to be lower. They will show a good percentage growth on that capex. But if you see the way the rupee is spent next year in the budget, you will see for next year that the consumption part will get a boost. Because ultimately, government has realized that what they do spend on infra is largely coming into a construction-related industry, because building ports, airports, everything, and those are temporary jobs. They're not permanent jobs creation. The private sector getting into capex cycle is what is going to lead to permanent job creation. The government has to support the private sector to come back. Now, despite the PLI incentives, despite so much, why is the private sector not stepping up? Because demand at the mass hasn't stepped up. The K-shaped recovery that we talk about means that volumes are less, value is high. So the volume segment, which is the FMCG segment, has suffered because the rural population suffers from three things. One is not enough drill down from the government through money to their pockets. Two, inflation, food inflation has been high, has been cutting into their consumer surplus. Three, consumer sentiment to spend has been dropped. Now, government in the budget, according to me, the biggest task is to reinvigorate the sentiment in the consumer. And that can happen through tax base being, whatever, the tax cuts is one way to affect the lower middle class. The second is some amount of giveaway where the direct benefit transfer comes directly to because when that mass market consumption steps up is when capacity utilization will step up, and then private sector capex can step up. So I'm strongly of the view that, and consumption, like you said, hasn't performed. So there's a value-based approach which supports consumption. There's a budget expectation-based which supports FMCG. And I think that if the government is smart and has its right, and I think domestic fund managers, the DIIs, would prefer this. Yes, and the tax collections have been comfortable enough for the government not to suffer on the fiscal deficit target. They might, for the future, project a more aggressive target. But for this year, I think, without losing out on what they promised as a fiscal deficit, they will be able to enough room to take care of the consumption bit and bottom of the pyramid part, which is why I think that there's a safety play in buying consumption. And if the budget really clicks all the results, we could see a good runaway rally. So I'm with the CLSA report there, and I broadly feel that smart thing for the government to do is to mix development and populism. So developmental populism, if I may frame that word.
Sure, very, very interesting conversation. I really don't want to leave it at that, but we don't have time. And I hope we can connect again once anytime before the budget. But with that, Sunil, thanks a lot as always for taking out time and putting things into perspective for us. Appreciate your taking out time.
Thank you.
Well, on that note, just want to quickly take a look at the market. Yes, it's a 200-point cut on the index, although we are above that 23,200 mark as of now, but November lows have also been taken out. So yes, a crucial support zone being taken out on the index. Let's hope things see some bit of a turnaround around midday or in the second half, and we end off these lows. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. But you guys stay tuned to Money Control for all your other news and updates, and I'll see you later in the day. भाइयों, एक बात बताओ, ये क्या